to give us their insights and help us find some trading opportunities. So good morning, guys. How are you?
Good morning.
Good morning.
Good morning. Good morning. Yes, it's a slow Monday to what possibly could be a very, very active week. I think investors. First of all, we have the coronation in England, so there's a UK bank holiday, so all of Europe was essentially kind of a little bit offline. But I do think investors and traders are kind of sleepwalking into this week because there's a big risk on the calendar that everybody thinks is going to go away, but I'm not so sure, which is the debt ceiling negotiations. I mean, both parties seem to be pretty entrenched, and you could obviously make a case for both parties, but it's irrespective of what the arguments are. I'm just wondering if they're going to come to terms before we start hitting a debt ceiling. Obviously, it's not the U.S. is bankrupt or is going to hit a default. It's more just that the actual event itself is kind of unprecedented as far as the financial system goes. If you don't pay your bills, you don't really find out what's wrong until you don't pay your bills, and it gets backed up all across the system. And that I think is a really, really dangerous point that they don't want to.
Let me ask you, Boris, how's this different from any other time that we've hit the debt ceiling and they've come to an agreement in the 11th hour? How's this different?
I think both parties are a lot more intransigent. I mean, you gotta understand, this isn't the conversation about the debt ceiling. It's a conversation in many people's minds about which way this country goes, because if you're looking at the Democrat side, they're essentially looking at this as a terrorist act of financial terrorism, because all of this money has been fully funded and agreed for legislatively, and they're trying to take away the money. They're trying to basically take away all the legislative achievements of the Biden administration by threatening to default the country. On the other hand, you look at the Republicans; they're saying, "Listen, we're spending way too much money, and this is our only way to control spending." And so, I'm not so sure yet. Before, it used to be a situation where the Democrats would kind of, cave over, give in to the Republicans. I'm not so sure they're going to do it this time, because it literally is. I think they are viewing it as negotiating with terrorists, and it just brings back that whole great Tom Cruise Tropic Thunder moment in my life, when Lou Grossman, where he goes, "We don't negotiate with terrorists," moment. But no, seriously, I don't know. I just think that the tensions on both sides are so much more different now than they were before, that the possibility of a accidental trigger is much greater now than it was before, from a political point of view. This is an economic.
Of course, give us
Yeah.
just from prediction wise, tell us what could happen on both cases. Let's say they meet it and there's no big deal. What happens to the markets? Let's say we go into a stop and they don't meet the needs. What happens then? Give us a best case, worst case.
So we've already had the situation where the government had to shut down. I think it was Newt Gingrich when they had to shut down for about 10 or 20 days, whatever it was. That obviously, first of all, it's a massive economic demand shock, right? There's a lot of people who depend on Social Security, who depend on other payments. There is a lot of corporations who depend on U.S. government invoices being paid. It's a chain reaction all the way down. It's like it's equivalent to you you have a credit card bill, right, every month, and you just say, I'm not going to pay it. I'm going to go charge up everything. I charged up, $100,000 on my credit card bill. Yeah, I'm not going to pay it. What do you think is the end result to all the vendors and everybody else on that chain when their revenue isn't coming in? So it could be a very, very contractionary impact that way. Plus, you really don't know. A lot of the stuff on the financial system is kind of just-in-time inventory as far as cash goes. So, if these companies don't have other sources of cash, they can't pay their employees. They can't, borrow money from the banks, because the banks are going to be super cautious now about giving money to anybody. And it just creates this really, really horrible chain reaction. Because again, this is money that's already been appropriated. It's like I already agreed to buy from you. Now I'm just going to welch on actually paying you. That's really what's happening in the economy. And when that happens, that creates a lot of unexpected problems, I think. So I very much hope, like Kathy does, that they come to terms, and it may be a situation where Biden blinks and just says, fine, we'll give back some of the spending priorities in order to make sure the country functions well. I don't know, but if it's a Mexican standoff, it could be very ugly, isn't that?
Got it. But if it's all met, it's essentially a non-issue. We just move on down the road, and that's it.
Yeah, no, it is a non. Yeah, in other words, if they can come to terms at the 11th hour, it's a big sigh of relief. It's actually probably a relief rally in the market because underneath it all, the fundamentals in the market are actually quite good. I mean, shockingly good on non-farm payrolls. I'll let Kathy talk about that, but far better than anybody thought. Overall growth is still pretty decent. Earnings are still surprising to the upside. There really is nothing on the fundamental side that threatens the overall positive bias of the markets. Yeah.
Excellent. And Kathy, I know you want to let your viewers know to check the link because we're probably going to be showing some charts. And guys, you could also post questions in the YouTube. We are live on YouTube, so head over there and go ahead and post your questions up. Kathy will relay those to us, and we'll get those out to you.
Yes, now is a good time to go to the YouTube link because I want to show you some charts on the debt ceiling that I was prepping while Boris was talking, but I just got to figure out how to zoom in. Hold on one second. All right. Okay, let me see. All right, I guess it's fine. Okay, let me share my screen. Hold on one second. So, obviously the debt ceiling, as Boris said, is a very big topic, and the government has been shut down before. So let's take a look at what this really means for the markets statistically and historically. So I'm going to share my screen. Okay, so right now, the first image that you're looking at is the periods of time where we had kind of showdowns in the debt ceiling. And give me one second. And it looks at how the equity market performed. The S&P 500 performed 1 week prior and 1 month prior to the political wrangling. And you can see overall, overall there's no real impact, right? It's like minus 0.23%, minus 0.06%, about 55 to 60% positive. And so you can see, we've been arguing that at the end of the day, oftentimes, the shutdown doesn't have as much impact on the markets. But a large part of that also depends upon how long it's been shut down. Let me see if I can make this big.
It's Control Plus. If you just
hold on.
There you go.
I was hoping for a higher res version, but okay. So basically, this shows you the length of the shutdown and the impact on, the S&P 500 during that period, and what happens once funding resumed, and then what happens in the weeks to follow. So if we take a close look at this, the last time it was during the Trump administration for 34 days, and during that time, the stocks actually performed very well during the funding gap, and then stocks rallied again once funding resumed, and 1 week later was overwhelmingly positive. Under Obama, pretty much the last four. Stocks did not deteriorate under the funding gap. And I think a lot of that had to do with maybe expectations that they were going to reach an agreement. Like once they shut down, they didn't think that was going to be shut down for long. And the expectations that they would reach an agreement, shortly thereafter. Before that, during Carter, we had, more negative performance.
So Kathy, can I stop you for a second? So expectations of the duration had a big impact on what stocks did?
I think the expectations of the duration of the shutdown has a more significant impact. And I think this is what this
than
is
the
from
actual shutdown itself.
Right. And I think this is what Market Watch is trying to show, which is that, on average during, the shutdown, stocks actually edged higher during the shutdowns that lasted 5 days or longer. But when the closures lasted for 15 days or longer, obviously, there's only a handful of those, but when it lasted for 15 days or longer, it actually led to an even greater, like 2.85% increase, which is what my arrow's pointing to during the shutdown. So I think if we take the two things into consideration, this and the previous image that we saw, I think what it's telling us is that, 1 month prior to the shutdown, there really isn't that much of an impact. 1 week prior to the shutdown, you tend to have more concern and anxiety and panic in the market that this may be happening. And then once it's shut down, you actually get a relief rally as a result of investors thinking that they need to reach a deal quickly. So I think, this is what we could potentially take away from what all of the other shutdowns that we've had since the 1970s. Does that make sense?
Kate, can you walk us through the timeline? It's May 9th is sort of like the initial conversation. Like, how much time do we have before this really becomes a unsolvable problem?
Well, June 1st is the date that Treasury Secretary Yellen says, that they're going to be unable to fund some major areas of the economy. So I think that's what, and also, the first of the month, people like round numbers. They like, easy, clear dates. So I think that's really going to be the focus. So President Biden has called congressional leaders to come to Washington to discuss the debt ceiling tomorrow. I don't know if we're going to get any headlines. Maybe we will, maybe we won't. We probably will. I don't think it's a closed door meeting, and I also don't think there's going to be any clear resolution or agreement out of tomorrow's meeting. But with that said, though, I think June 1st is really the day that everyone's focusing on. Got it.
So yeah, so it's going to be an interesting month of March, and I think as the if the market starts to sense that there is just no give on either side, it'll become a bigger story.
Yeah.
Right.
The main takeaway is that I want everyone to understand off of these tables that created by MarketWatch is that the week leading up to June 1st, if there's no improvements from now until then, it's probably going to be risk aversion, stock equity market weakness. And then once the government shut down, they're usually the first couple of days, there's probably some anxiety, but then the discussions get really accelerated and reaching an agreement because, the stakes are obviously very high. And as we near the agreement, that, tends to be more positive for stocks as, investors are getting a relief rally. And the longer the shutdown, historically, the more positive the recovery in stocks.
Yeah, I guess because the idea is that there's going to be catch-up mode, right? So the longer the shutdown, when it revives, there's all this money that'll be released into the economy, so the stocks start to rally in anticipation of new money circulating into the economy.
Right.
It makes sense. It makes sense. It's an interesting macro environment. I mean, as I keep saying, the single greatest macro mistake that the market has been making is to call for a recession, right? It seems like with so much tension, so much political intransigence in Washington, so much geopolitical tension with Russia and with Saudis raising the price of oil, with Chinese being intransigent, with Chinese economy relatively slow. One of these fascinating things about the market is that you have this incredible data with Europe essentially, on its last legs. You have all this data that basically shows we should all be essentially a 1930s recession, and nothing could be further from the truth. We're literally in some of the best economic performance times in a long, long time. And I know people are going to bring up the idea of inflation, but honestly, inflation is a minuscule impact to the economy. Let me rephrase that. So this is not me talking about this. This is Citibank economists have talked about it. When you look at the U.S. economy and the U.S. consumer, you really only care about the top 20% as far as spend goes, as far as actual spend, because the top 20% of the U.S. economy, are responsible for 60, 70% of the actual spend of the economy. And for that cohort, times have never been better. You go to airports, you go to everybody keeps saying to me that lines at airports, lines at cruises, lines at restaurants, lines at venues just are nonstop. They're just reading that tickets to Europe this summer are going to be airfare tickets are going to be through the roof. So that's the irony of the whole thing. It's very interesting to see sentiment be so dour, reality be so cheery. I think that's massive disconnect in the markets these days.
So, Boris, on that topic, what do you expect to see from the senior loan officer survey this week?
I think sentiment there is definitely much more dominant than the actual economy. So I think senior loan officers, especially given the huge stresses we have in the regional banks due to the rapid steepening of the yield curve by the Fed, they're going to be a lot more cautious. I mean, you hear, Dallas Fed. I forgot who else, but Dallas Fed especially. There was this, statement that they are seeing much lower much harder credit conditions. And that's going to have an impact. But still, so far, it really has not destroyed the economy. I read an interesting, actually, counterpoint to all of this. Was a macro analyst. I forgot his name. It was an interesting guy. He was basically making the same argument as me, that, listen, it's nowhere near as bad as everybody thinks. And part of the reason, by the way, is actually because of the infrastructure spend. There's been a huge amount of money appropriated to states to do lots and lots of infrastructure spend. Those projects are multi-year, multi-high commitment projects, and no regional bank scare stops those things, and that creates just a massive, massive long-term bid for spending, which I think is probably responsible for why the housing market hasn't collapsed, why restaurants haven't collapsed, why every forecast of the Cassandras has failed miserably so far. So it'll be interesting to see. Yeah.
Let me ask you, Boris, are you worried at all about the recent decline in the KBW bank index?
It's
like no one's really banking sector stresses came back. I think it was 2 weeks ago that we were talking about it, and then obviously last week it was all about central bank rate decisions. But the bank index has been falling quite a bit as investors are looking at 6 to 10 other banks that that could go under.
Right. So there is interesting things that are going on in that part of the market. First of all, obviously, yes, there's this fundamental fear that a lot of these banks have been caught with wrong liabilities on their issues, because the Fed went so hard so fast, and they all have, let's just put it this way, they all have mortgages at 3s, and they got to they got to pay out at 5s. It's very, very expensive to kind of make money that way. So yes, they're caught. They have a big liability mismatch on their books. But the second thing that's been happening to the index is there's been a massive speculative run. Huge amount of the declines in the shares of those banks is not a result of their fundamental flaws, but because of the huge speculative. Basically, speculators have been shorting those stocks so brutally in order to cause investor fears and deposit fears, so they would trigger a deposit run and therefore put the bank in a receivership. It's kind of a self-fulfilling prophecy. Now, is it immoral? Absolutely, but it's just market dynamics. There's been a lot of talk, which I think I actually fully support, that we probably should not. This is the one sector. Banking is always the one sector that we have to ring fence, right? Because banking is not like any other economic activity. It's a utility. It's like roads. It's like water. You can't say, well, some guys are allowed to pollute the waterways and other guys are not, because that's what essentially the short series are doing. They're just basically dropping little toxic water into the thing, and they're saying, hey, maybe that will stop the people from taking the water from that water company. You can't do that. It's a public utility good. So there's this big argument now that they should basically not allow shorting of bank stocks, which would be interesting.
How far is that argument along? Is that just political pundits, or is that actually?
I mean, it's
on
interesting.
The floor?
I wonder if they certainly can do that. It's not like the exchange can do that. There's like regulators can do that. It's not it's by diktat. It's not like they could just say we're going to put a 40-day moratorium on all shorts. They do that. All those shorts are going to get squeezed up the wazoo. They're going to be dying. So, that's a possibility. I actually think they should signal that to the market. Say, hey, stop gunning those, because they're gunning those stocks to zero, not because they're worth zero, because they know that if they do that, they will be worth zero. It's just markets always get extreme, but in this case, you're playing with fire because you're playing with really the financial infrastructure of the country. You can't allow people to set fires to that. So it's completely different from shorting Chipotle or whatever. Like something that is not economically crucial to the economy. So, I think that's another interesting. So, yes, the regional bank story hasn't gone away. We're going to be watching that very carefully. The debt ceiling. It all, by the way, every financial crisis always comes down to credit, right? Somebody said that the other day, and I was like, wow, that's probably a very, very true. Ultimately, it's always about, credit.
Well, credit's the most important aspect of the economy. So I think that when credit is at stake, people start to think about their own investments, and what was supposed to be guaranteed is no longer guaranteed, and they start to really worry. And that's something that central bankers, are still trying to grapple with, I think.
Right.
For those of you that are on Twitter Spaces, you can join us in the YouTube link. We're going to be sharing our live charts and everything. And maybe, Boris, maybe you want to share your oil chart, because last week on Friday, which actually wasn't that long ago, Boris was very bullish oil. And he talked about how he thought, this was Friday morning, he thought, oil was pretty much at a bottom, and, the 60-ish region was a really good level to buy. This morning, crude is at $73. And so, oil's had a very nice recovery. And, Boris called out Exxon, which, seems to be performing really well as well.
Yeah.
But, many of our traders like to trade oil. And I think that, this move, this move looks like it still has a bit more room to go, right?
Yeah. So this is hourly chart. I just kind of want to pull back a little bit. Actually, if you look at the hourly chart and you look kind of the sentiment shift here, you see that it went from red to green early Friday morning. It was like 2:00 in the morning, New York time, that we kind of shifted sentiment here. But yes, oil came back. It's funny, look, I don't think I had any brilliant insight. There was an article today about why is Warren Buffett. Now, Warren Buffett has been investing on and off into oil since the early aughts. And he's actually had a lot of bad experiences with, he went into Conoco in 2007. That cost him billions and billions of dollars because oil collapsed after that. He went in and out of Exxon in 2014. He came out of it. And yet now he's really returned, full force into the oil stocks. And it was interesting because they were saying, why did he decide to do that? And the argument was kind of my thesis. His argument was like, listen, this isn't going to, it's not like, I think we're going to be in the new golden age of hydrocarbons and we're all going to, essentially burn ourselves to death with climate change. His thesis was sort of, I think, a very realistic assessment that, look, it's going to take much longer than we think to do a green economy transfer. In the meantime, oil still remains the single most efficient, energy substitute for all of us. And most importantly, even if we don't see, oil spiking to $150 because of shortages, there is a natural level of demand between 65 and 85. And as long as it's a 65, 85 band, all of these majors, including Exxon, including Conoco, all the producers, upstream and downstream, are going to just do very well on a steady basis. That was his equity argument. And that's sort of like, my commodity argument, that it's not that I'm a uber bull. It's not that I think oil goes to 250. I do think it becomes eventually substituted out as we move towards different technology. But speaking of different technology, by the way, so I just over the weekend, because of course I spend half my time on YouTube just doing dorky things. Everybody's focused on electric vehicles. And we talk about the fact that EV needs to go to 10% in order to really capture the market in autos. And that's going to, really, when EV goes to 10%, it's probably going to have a big impact on oil going down. But Toyota is really making massive advances in the hydrogen. Hydrogen has a couple of really key advantages over electric vehicles, most notably that much less need for lithium, much less need for metals. So it's far less kind of environmentally intense. But more importantly, it's a 90-second refill. The single biggest knock on electric is that it's a half-hour refill. Nobody wants to spend half an hour at the gas station. The hydrogen is literally the same thing as gasoline. So I do think substitutions are coming, and it may be much faster than we think. But much faster isn't, next year or the year after that. It's more likely, 5 years, maybe 3 to 5 years forward. In the meantime, you have this very, very steady bit, especially because I don't think you're really seeing too much new product coming on the market. It's very hard to find oil these days in large enough quantities. So you have a finite amount of supply, a very, very decent amount of demand. You got to believe that it's a 65, 85 trade. And obviously when you're close to this, closer to the bottom, it's going to be a great buy. So that was my thesis, and it definitely worked out very nicely on a short-term basis.
So while I agree that oil is a good buy between 65 and 85, I have an EV, and I can tell you I never spend 30 minutes waiting for it to charge. I just plug it in, charge it overnight. It's I don't have to worry about it ever.
Yeah. Take a trip to LA in that EV. Let's see how long you spend.
Why would I ever do that?
Well, I don't know, because people like to drive. No, it's fine. I know it's but it's still a major objection to a lot of people as far as the charge even 15 minutes. Like, I can't tell you, I was just charging my little Mini, and it's literally a 30-second to 60. It is mass. EVs are great if you're charging it in your garage every night and you're just going back and forth to work. But if you decide to take a road trip, it becomes much more of a challenging, target. So I'm a big EV fan. All I'm just simply saying is that substitution technologies are definitely coming. They're just not coming, tomorrow, and that keeps the oil business. That in combination with the fact that there's just not that much new oil coming online, so they're not. Remember the thing that happened in the 2010s to 2020s is we had all of that fracking coming online. It was effectively oil, right? Just came online. That has kind of exhausted itself in terms of the kind of size that that we had. So that's
Now that you're on, can you move to the daily chart of oil?
Yeah.
And zoom
guys,
in?
I know we have a lot of viewers who usually have questions on oil. So if anybody's watching, you want to put a question into the comments here on oil while we're on the topic, now would be a great time.
So
yeah,
we're looking
you want
at
to
the
look at
daily
the lows?
chart. No. Just this is fine. This is so we're looking at the chart of oil, and this is a really good time to talk about this. And those of you in Twitter Spaces, go into the YouTube stream to look at the chart. We have CPI this week, and one of the most important inputs into CPI, of course, is the headline number is oil. So, Boris, can you track with your mouse the move in oil in April, just so people can show where it started and where it ended?
Yeah, let me.
You maybe draw a line or an arrow.
I'm gonna try. You're asking a lot of me, but I'll try here. Let me find the right tool. This
Just
is
put a horizontal. It's fine. Anything. So April 1st.
Okay, so this is kind of like May 1st, right? And what is April?
So oil gapped higher pretty much on April 1st. So right on April 1st is pretty much $80 a barrel. And it ended May 1st, I would say at about $72 a barrel. 74 is where April 30th was, or April 28th. So oil actually fell quite a bit in the month of April. So the number one most important piece of data on the calendar this week is going to be Wednesday U.S. inflation report. And, we talked about this last week about how if the Fed is not crystal clear in its guidance, the data that comes between now and the June meeting is going to be more market moving, more important. So when the Fed met last week, they set the stage for a pause. They didn't necessarily, signal a pause, but they definitely set the stage by adjusting their policy statement and taking away the language that suggests that more is to come. So the market has raced to adjust its expectations, and now the market is pricing in. I think it was like 89% chance of no change in June. But on Friday, we had a hot non-farm payrolls number, a really, really strong jobs report. So that leaves investors confused. Even though Fed fund futures have not budged at all, and the market is not as convinced that even with the strong jobs number, the Fed is going to pause. The decision of pausing or not really rests on inflation. It primarily rests on Wednesday's report, because CPI these days is even more important than NFPs to the Fed, because we know the Fed thinks the labor market is strong. We've seen the data that shows the labor market is strong. And so what they're really worried about is inflation. And right now, the market is looking for CPI to grow at a faster pace. If you look at the eco calendar, let me just pull it up real quick. On Wednesday,
I can pull it up for you. Okay.
Yeah. On Wednesday, the forecast is for 0.4% CPI growth, up from 0.1%. You have to zoom in a lot, Boris.
Yeah, I will.
It's on Wednesday. So the market is expecting a hotter number. And based upon the decline, first of all, we know that, inflation did not get the support of oil in the month of April. And, there's general sentiment that inflation in general has eased. So because of all that, I think the risk is to the downside for the CPI report on Wednesday. And if CPI surprises to the downside, then we could see a much more meaningful rally in euro, pound dollar, Aussie dollar, sell-off in dollar yen, because investors who are kind of, on the sidelines right now, or just kind of confused as to, what happens next in June, if we get a softer inflation report, we'll really latch on to that and, see that as an argument for why the Fed definitely will not raise interest rates in June.
Well, I was going to ask you, what do you think is going to be a hotter mover, short dollar yen or long euro dollar? If you're right, inflation comes in, let's say we come in 4.8, something that's just, or core comes in at 5.3, 5.2, which is significantly lower than what the market is looking for. What do you think is going to be the better trade?
I think the better trade is going to be pound dollar. Because going long pounds against the dollar, because BOE is expected to raise interest rates on Thursday. So, and the UK GDP data at the end of the week, beginning of the year, the UK was like doom and gloom scenario. So we're going into recession, we've got a contraction. They basically set the stage for doom and gloom. But there's a very strong possibility, and the market expects, if you look at the calendar, the market expects positive GDP growth from the UK in Q1. So you've got the BOE rate hike, you have the prospect of a GDP beat that I think really makes pounds. Pounds already at a 1-year high. It hit a 1-year high this morning.
That's another thing. That's another thing I love about macro is that every conventional wisdom was, UK is going down to parity. Brexit has destroyed the country. They will never come out of this alive. Blah 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 blah. And we're on the exact opposite. Like it's literally the exact opposite of every macro prediction that I haven't looked at pound in a long time, but that's shockingly strong. Really, really strong. Look at that. Look at that breakout above the 25s. So that's really interesting. Yeah. I kind of now it makes a lot of sense now that if you're right, that if you're right on the CPI that it's a cool CPI, cable is going to be the
everyone's going to be laser focused on pound dollar this week because we've got US CPI, BOE as the main events.
I'm going to try. I haven't committed yet just because I need to make sure that I can get my daughter off to school. But if I can do that, I'm going to live trade CPI, and obviously we traded against the indices, but we also traded against FX these days. I was going to trade a dollar yen, but now I'm going to add pound dollar to this thing because it's definitely going to be an interesting instrument to trade. So those of you guys who are in Surge, come join me. I'll let everybody know by tomorrow for sure if I'm going to be committed to it. But if I can, I definitely want to trade the CPI numbers 8:30 with you guys. We're going to use our balance.
Where could we join you?
You can join us in BK, in the BK room. For everybody who is a member of Surge gets 1 month free of BK services. So be sure that you obviously sign up and get into our Discord. And then in Discord, I publish the link every day, so you could just simply click on the link and go to.
But the thing is that even if you can't live trade CPI with Boris, Boris live trades every single day, so that's part of what you get from the Surge audition. So even if you can't make CPI, every single day there's live trading.
Right. Exactly.
Right. And everybody who auditions with Surge gets 30 free days of BK trading, BK Forex. So definitely take advantage of that. You guys all have that in your email welcome folder. Have it on our website as well as the BK website. So everybody can take advantage of that and get the mentorship you need here.
Just make sure in your welcome folder there's a form you need to fill out. So just fill out the form to us, and you'll be all set.
So we have a couple questions on YouTube. The first one is, do I believe in support and resistance? Because I don't really talk about it often. Yeah, I absolutely believe in support and resistance. Maybe we're just not talking about it, in the charts that we're looking at, but we're just looking at oil, and well, actually, no, we weren't really talking about it earlier, but support and resistance is very, very important. And we particularly are sensitive to significant swing highs, swing lows. And so that plays a very, very important role in my trades, as well as Boris's trades. In fact, Boris's trades key off of prior support and resistance levels. Does the S&P 500 and the dollar and the US 30 affect dollar movement? And if yes, how can we trade it? Actually, on our YouTube channel, YouTube.com/BK Forex, I have a video on how to use stocks to trade FX. And that basically addresses this directly, which is that stocks do have a very significant impact on how the dollar moves. And it impacts it in the way of risk appetite. Typically, if investors are optimistic and stocks are rallying, that tends to be positive for riskier currencies like Aussie and Kiwi, and negative for the dollar. When investors are nervous, the dollar tends to rally, catching a safe haven bid. Now, dollar yen itself kind of sings a different tune because that's a different risk currency as well. But that's I encourage you to look up that video on YouTube. It's very valuable. Should we go long or short oil, Boris? Any comments on that?
Yeah, I mean, well,
I think.
Yes, I think you should. I think oil still has more juice to go. Like, if you're gonna hold me to the next 50 cents, I have no idea. But I think it's a decent trade, certainly for the next week or two. I obviously, although I will say this, that no, I was going to say, it's having a big risk-off impact depending on the talks and everything else, but that's just far away. I still think oil probably has a chance to rebound. The rally isn't done yet, but you should have gone when I told you to go. Right now, I'm much more neutral on it. But
he gave us the signal last week, guys.
Gave it a signal last week. That's right. There's more ideas. Like, speaking of that, by the way, if Kathy's right on CPI, let's take a look at gold. Right, here's gold. Because that's going to be an interesting. Let's just even take a look on the hourly chart here.
Yeah, and for those of you that are on Twitter Spaces, Boris is pulling up his gold chart, and he's going to zoom in, right? And and you can see it on YouTube. So
you have. Remember, I said gold is really not a trade till it breaks 2,100, and everybody's like, "Oh, it's good enough for 2,000. It's good enough," and broke through 2076, came right back down. Gold is just really playing with people's emotions at this point. But what's interesting to me, while it's making piercing highs, it's not really creating any kind of destructive lows. In other words, it's not breaking lows to the long side. Let's just take a look, maybe even at the 4-hour chart. I'm just looking at the this is the 4-hour chart. Still a very consolidative, constructive move where the 70s, the prior low hasn't been broken. The 50s, the prior low hasn't been broken. Now it's the 2000s is the prior low that hasn't been broken. That's all suggestive of a further upward trend. However, and again, if K is right on like lower CPI, cooler CPI means the Fed holds off, that could be the event that could push us through the 2,100. Like, that could be the move higher. Because remember, gold hates high interest rates. It's the biggest competitor against it. And if there is a chance that the Fed holds on interest rates, that makes gold that much more attractive to investors because there's no carry cost to it. The carry cost is smaller than relative to the treasuries. So to me, gold is probably like on a long-term basis, still a very, very bullish looking chart that marches up higher. And then a 2,100 break could be like that very, very significant longer-term break for it to the upside. So I'm going to be watching that very carefully this week as a referendum, effectively, on rates, dollar, and everything else that's happening in the market. Because remember, gold. If we get to that whole idea of like, oh, they're gonna not compromise on the debt ceiling, gold then is just going to attract every gold bug in the world. It's like, oh, U.S. dollar defaulting, the economy is going to shambles, paper money is terrible. All the arguments that gold bugs love to make. But all of that is going to create very, very positive sentiment moves towards the price. As always,
like you've got two really big factors to watch that could cause a gold breakout. One being the inflation data, and two being the debt ceiling. Probably in the near term, I think, gold bugs tend to look at the politics more than the economics. And I think, the debt ceiling, it may be more sensitive to debt ceiling headlines than the inflation headlines.
Yeah. But, you get this 1-2 combo of like cooler inflation and intransigent debt ceiling. That's very positive. Gold, we could see the 2100. And then just, when it goes 2100, the headlines across the world, gold all-time highs, blah, 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 really creates its own self-fulfilling prophecy. Just like we're talking about the shorting the banks creates its own self-fulfilling prophecy. Markets affected. As a matter of fact, when I was younger and I used to take economics in college and I graduated, the whole econometric model really is based upon the idea of self-fulfilling prophecy. People feel good, they spend more money, the economy expands, people feel good. People feel bad, people stop spending money, the economy contracts, people feel bad. It's really literally that stupid and simple in basic econometric models in how you do it. And the idea of the government, Keynes's idea was that when it gets to a point where people are just feeling so bad and they don't have any money to spend, the government has to invent creating money to give it a booster shot, like the virus against the recession, give it a booster shot to move the economy. That's literally economics 101 for anybody who doesn't understand how economy works. And markets are very much the same way. They're all self-fulfilling prophecies. So we could be looking at this kind of a self-fulfilling prophecy of a gold fresh highs trade. Definitely worth watching. And more importantly, when you're looking at just kind of the technicals underneath it, the price structure is telling you that they're buying every dip and they're buying it higher. You got to like it. You got to like it here. And I'm looking at the gold chart here. I think that's an interesting trade. That'll be my trade for the week. I'm going off of Kathy's call on CPI. If we're both wrong, we get blown up. But at least I think it's a reasonable trade with well-defined risk. And the risk here would be probably maximal risk that I would want to have would be this low over here, this 1965 would be my terminal risk. We break that. Clearly, that's going to be a much more negative event for gold. But until that happens, you got to be a buyer.
There you go, guys. We got another call in the books.
Another call in the books.
Don't ask for it next week.
That's it. Don't ask for it this week.
We will revisit on Friday and see how everything shapes up. Exactly. Yeah. We have one question about sterling, about whether sterling is good to go long for the next week or so. Like I said earlier, I'm bullish sterling going into the Bank of England rates decision. However, I think that even though they're going to raise interest rates by 25 basis points, I think that the votes will not be unanimous. If they're unanimous, that would be widely positive for sterling. But if there's some dissenters, I think that could diminish the positive impact. So I'm only positive going into the rate decision.
Kate, can you give people just maybe 2 or 3 more insights into the whole UK story? This UK story is inflation is some of the hottest numbers in the OECD land.
Yeah, it's exactly that. Inflation is soaring. We have the PMIs in a lot of countries have been deteriorating, which is the manufacturing service sector activity indices. But in the UK, they've been surprising to the upside. So it's basically the government set very low expectations at the beginning of the year. And I think that the fact that they're consistently beating it in terms of data is what is triggering the market to think that they're going to raise interest rates. I think there's still a chance they could hold, but that's definitely not what the market is pricing in.
Interesting. Okay.
But good. I have a question for you, Boris. Since you've been talking a lot about sentiment, we have the UMich Consumer Sentiment Index on Friday. And I actually don't have a good feel of whether consumers are going to be more optimistic or pessimistic. Do you have any insight on that?
I think they will be better. Let's just look first of all what the forecast is. You remember it's been in the dumps for a very long time, and again we have this massive discrepancy between what people feel and what they do. As
it's expected to be marginally weaker,
right? And I think that might be a surprise. Where's Wednesday?
Friday.
I'm getting up there on my big screen here. Here we go. Okay, so you miss just 60. I think we probably see maybe 65. It's not. I don't think it's it's not a big mover anyways. Inflation expectation will be, I think, the interesting thing. That does the market think it's going to be hotter? I think they probably will stay the same, as you said, mainly because oil has been muted in the month of April, and you haven't seen a lot of pass through on the on the inflation front. And I think that's actually going to be the big story on inflation as we go forward. It's not that inflation is going to go away, right? Inflation is probably going to stay with us for quite a while. High price levels are going to stay with us for quite a while. The critical question is, are those price levels going to stabilize and pretty much stay? Do we have a one-time reset, or is it just going to continuously creep higher every month or every quarter? And I am of the opinion right now that it was a one-time reset, that it was a supply shock. I keep thinking that the grinding of technology with all of the new resources of software and hardware development, AI and everything else is just inevitably going to, like it has for the last 20 years, destroy costs to the downside. And that is going to come back to take impact again, because now that we've all been able to absorb all of the supply shocks, you're not going to get too much of a move. The big outstanding question, which is hard to say, is services. This is what the Fed is focusing on. Are people going to just creep up their service fees continuously to see how far they can get away with in the marketplace? And that could have a continuously strong impact on inflation. But I think goods inflation for now is pretty much plateaued and is not really going to rise much higher. That's my takeaway in all of this. So we'll be watching inflation expectations, sentiment. I think it's going to probably print 64, 65, and inflation will stay muted, maybe even go 4, 5 on it, which will be relatively bullish. Let's see how much of an egg on my face do we have, because it's going to print before we go on Friday live, so then we can compare and see how good my forecasts are.
Right. Hey, before we go, guys, did either of you have any trades? Kathy, did you have any overnight trades?
Yeah,
share any charts?
We did very well overnight. I'll share my charts real quick. Hold on. Present, share screen. So, okay.
I'm doing a lot better since we started the broadcast. So maybe we should just keep on going with the broadcast until we finish the day. No, I'm just kidding.
So what I was saying is that for those of you that have never seen my charts before, this is my zip chart. And the background represents the longer term trend. So green is bullish, red is bearish. And where it is in relation to the indicator line is the shorter term trend. So I set my trades at the Asia session, and I'll start with pounds because we actually went long pound at 8 o'clock New York time, which is right over here on Sunday. And, it was based upon my overall thesis that, the pound was going to rally ahead of BOE. And I woke up this morning and we had some, very, very nice profit targets. This became a 40-point move in pound dollar. I also sold dollar CAD last night based upon the oil decline. I saw that oil, this was where oil was hovering near its recent lows. And then we'll look at the daily chart in a second. So I want to show you what it looks like on the daily chart. And I felt like it was going to break down because oil was recovering. And because on Friday, we had hotter Canadian jobs data. And that also hit my profit target when I woke up this morning. I also went long euros. This one I didn't want to show first because I actually front ran the trade, which is I broke my trading rules a little bit, but it still worked out. I got in as soon as the background shifted from red to green because I saw that the dollar was kind of dripping lower. I was bullish euros, I was bullish pound. I saw the risk currencies were kind of rallying. So it wasn't the quintessential perfect zip trade because we were below the indicator line. I would rather trade when we're above it. But still, even though I took the trade and broke my rules a little bit, that one also hit profit target when I woke up this morning. So that's how, what I want to show is the dollar CAD. So we went short dollar CAD here, and I really liked this trade. Let me get rid of the zip. And then we'll put this back on because on the daily chart, the day prior, we had closed at the lows, which I really love. When we close at the lows, that indicates, obviously significant bearishness and, there's no let up by the end of the session. And oftentimes when you see that, there tends to be continuation in the next day, in the session that follows. So I loved that it was below all the major moving averages, closed near the lows, and I felt like there's a good chance that it was going to continue.
So, when people ask Kathy about support and resistance, this is what she means when she's talking about support and resistance. Kathy loves to use moving averages as measures of either support or resistance, and then price flow as a breakout barrier against those numbers. So she's not drawing these little horizontal lines from a thousand days ago that nobody really cares about as her measures of support resistance. She's actually using indicators that really encapsulate the actual current price action and positioning within that price action, and then using the price flow as a trigger point. That's it's been a very successful strategy for her. I've seen her do this 1,000 times. Where if she this is her favorite setup for zip and everything else, where it gets lots of moving average clearance and she gets the momentum flow. Then you have a huge probability for continuity trade in the direction.
All right. So what is my long-term projection for pound dollar? We're traders. We don't make long-term projections. We just trade the charts and we make consistent, steady profits. How do you find your profit targets? You become a member of BK. I mean, those trades went out to our members last night and they hit profit targets this morning. The MAs that you're seeing on this chart, which you can probably see it, it's on the upper left-hand corner, are the 20, 50, 100, and 200 SMAs.
Yeah.
And I love all the questions, lots of great questions today. I love how everyone's getting much more.
Yeah, a lot of good interaction. Thank you, guys.
Yeah.
Sounds good.
They liked our calls from last week, so now they're like, okay, these guys might be for real. Okay. Now I want to know what they really think.
Exactly.
No, that's great.
Put it on the Discord. We got some right.
Let's say, we got some right. Exactly. No, I mean, it's very interesting, very exciting. Hope you guys really enjoyed. We love doing it. We'll be back with you guys, I guess, on Friday. We're going to tally up everything that's going on. So between now and then, there's going to be a lot of stuff. Those of you in Surge, or those of you who want to join Surge, it's not too late. Join Surge today. Live trade with me on Wednesday. You'll get a really, really good idea of how I use my algorithmic trading techniques to actually trade news. It's one of those.
Right.
I was like, I'm calling it my bounce strategy is designed purely for technical algorithmic trading across the day on a continuity basis, right? But just like penicillin, right? Penicillin, Alexander Fleming discovered penicillin by accident. He was actually looking at, he was looking for like bacteria stuff, and he found the stuff in the middle, like, the stuff that everybody was not looking at. And that's where he discovered antibiotics, by looking at stuff that everybody else was throwing away. So same way, bounce, I never designed bounce to be a news trading strategy. It's become a massive, like a heat-seeking missile news trading strategy. So completely by accident, I call it the penicillin of strategies. It's really, really effective. So I'd love to have you guys in the room, because hopefully we're going to hit all those targets like we did with non-farm payrolls. So
nice.
Yep.
And before we go, Kathy, would you just give us the news events of the week that everybody should be paying attention to?
Absolutely. So there are three things to watch. It's going to be U.S. inflation report on Wednesday, Bank of England policy announcement on Thursday, and then debt ceiling headlines. They've got a meeting in Washington tomorrow. We may get some headlines off of that. We'll continue to get headlines throughout the course of the week and throughout the course of the month. So that's definitely front and center. What I was just going to say quickly, every Monday and Friday, 11 a.m., that's when we live stream with Corey. So please make sure you mark your calendars if you like what you're hearing.
Yep. And I'm going to just finish up with showing you what happens in markets every single day and why it really pays to trade with us and understand if you're losing in equity markets, this is why. This is why you're losing. Because like everybody else, let me just take a look at NASDAQ. Let me show you NASDAQ. Let me show you why you're losing. You're coming into the equity market. You're looking at NASDAQ. This is the midpoint. This is the high of the day. This is the low of the day, right? And everything is red, and everybody's selling NASDAQ. And you're like, oh, this is going to go another 100 points to the downside. And you get short over here. And oops, all of a sudden you get clipped and clipped and clipped and clipped and squeezed mercilessly. It's not that this happens every day, but this happens so many times during the, like, literally, if you've actually watched how the markets up, the reason why markets are so hard to trade is because, especially the equity markets, they never ever go in a straight line up and down. They're always faking you out. They're always zigzagging you out. And the thing that makes our strategy so robust is that we're designed for this mind game. I'm trying to keep my mouth clean here, Corey, from like saying exactly what the dealers do here. But our whole strategy is really designed to play along the mind games.
We appreciate it.
Yes. And that's what makes it so powerful. We were short, deep in the red. And then when we flipped around, the algo went right back, flipped itself around, because the algo has no feelings, has no ego, has no position. And we flipped around. I just literally just went to right now as we're talking, went to days highs in the P&L today on all the accounts, because just, understanding that it's going to flip around, that's where all the money is made on that flip. So I just leave you guys alone. I'll be happy to explain all of that, of course, in our room. I explain it every single day. Come live trade with us. Come hang out with us. Come get Kathy's FX trades, which are dynamite. And we'd love to have you around.
Awesome, guys. Thank you so much. We'll see you both on Friday. Have a productive week.
Thank you, man. Take care.